Welcome. Just We are continuing our chapters accounting for merchandising operations. We are following this book. This is accounting principle book. Writer Weygandt Kimmel Kieso. And today we are going to discuss record sales under the perpetual inventory system. This is learning objective 3. And in this lecture, just first one, we would like to say this record, that means under the perpetual inventory systems, that means sales record, made using cash or credit. That means sales may be cash or on credit. Number one. Number second, sales revenue, like sales revenue is recorded when the performance obligation is satisfied. That means after satisfaction of our sales revenue, just we need to be record these items. Number three, performance obligation is satisfied when the goods are transferred from the seller to buyer. That means seller to buyer when just we can send our goods, we call this is the performance obligations is satisfied. That means we have sent our goods from seller to buyer, and buyer has received this and we are satisfied. That means the seller is satisfied. Okay, and sales invoice should support each credit sales. This is our sales invoice number 731. Just sales invoice should support each credit sales. I think everybody is clear. And now we move this slide. Journal entries to record a sale. Just when we record the sales, okay, under the perpetual inventory system, the seller will record this cash or account receivable debit and sales revenue credit. Number one. Number second, cost of goods sold debit and inventory credit. Okay, next. PW Auto Supply records the sales of $3,800 on May 4 of Swag Studio on account. Illustration 5.6. Already we have passed this illustration as follows. Assume the merchandise cost PW Auto Supply $2,400. So this is our sales revenue and this is our inventory. The inventory reducing here. So very easy to understand. Account receivable debit, that means this is the credit sales or on account sales, and sales revenue credit. Always sales revenue credit, revenue is always credit according to debit credit procedures. And this is cost of goods sold debit and inventory credit. Okay, next. Sales returns and allowance. This is very nice to get this point. Flip side, that means this is vice versa, purchase returns and allowances. Or contra, this is revenue account to sales revenue. That means it must be sales returns and allowance. And sales not reduced, debited, because would obscure importance of sales return and allowances as a percentage of sale methods, or could distort comparisons. And now sales return and allowances, just this is an example. The illustration, this illustration we have found, prepare the entry PW Auto Supply would make to record the credit for return goods that had $300 selling price, assume 140 cost, or assume the cost were not defective. Okay, so defective is another matter. This is not defective, so this 300 sales returns and allowance will be debit and account receivable credit, and these items 140, this will be the vice versa. That means inventory debit and cost of goods sold credit. Okay, next. And this is the scrap value 50. So sold returns and allowance would be same, and scrap value just for this inventory just will be 50, inventory 50 and cost of goods sold 50. Okay, next. Question, just this question, I am offering this question to my learners. How could you answer this question? The cost of goods sold is determined and recorded each time a sales work are seen. That means cost of goods sold is determined and recorded each item, item by item. That means each item, for each and every item. Just this is followed by a perpetual inventory system only. Okay, this would be the answer. And sales discount offered to customers to promote prompt payment of the balance due. That means if we offer, that means the seller offer any just offer to the customers or the buyers, please pay promptly. And for this prompt payment, just sometimes the seller offers, and he collect the dues easily. And contra revenue account debit to sales revenue. Okay, here sales revenue 3800, and this is the sales return, this is the sales discount. So total net sales would be $3,430. And this is assume stock stereo pays the balance due $3,500, gross invoice price 3,800, less purchase returns and around 300. This is very well known figures to us on May 14, the last day of the discount period. Prepare the journal entry PW audio supply make to record the receipt on May 14, and this would be account receivable 3,500 and discount 70. This is the debit, and account receivable credit, and this rest figure would be the cash 3,430. Okay. Now, 1 September 5, dealer where company buys merchandise on account from John to Diaz company. That means the buyer, dealer Hoa company. Okay, the selling price of the goods is $1,500, and the cost of Diaz company was $800. Okay, so this question we can answer or entry firstly. Account receivable debit and sales revenue credit, and 800 cost of goods sold and inventory credit. Okay, and now the next portion on September 8. On September 8, dealer returns defective goods with a selling price 200 and fair value of 30. So for this two entry would be recorded here. Sales returns 200 and account receivable 200, and sales return 830 and account cost of goods sold 30. Okay, I think everybody is clear. Thanks for everyone to attend this